Does age matter when you're getting a whole life insurance policy and cash value is your goal? The answer to the question is not really. We'll answer this question in detail during today's video. So what we're going to look at is getting a life insurance policy where cash value is the goal, meaning you're not getting a whole life insurance policy and saying, how much does it cost? Because if you do it that way, it's going to cost more as you get older. Instead, you're going to say, I want to put this much money in. And what we're going to look at are examples of policies on a 25-year-old individual, 45-year-old individual, and 65-year-old individual, all putting the same amount of money in with the same insurance product, with the same insurance company. We're going to look at the same design. We see this 1090. What this means is that of the total payment going toward this policy, the base premium is pushed down to 10%, which is as low as we could push it with the companies and products we're looking at. And this design will typically increase the cash value and also increase the flexibility because we're only committed to that minimum 10%. Now, when answering this question, does age matter? Health is a factor here. And I say that because typically, as we grow older, the likelihood of a health issue occurring does increase. It happens. So when we look at a comparison of a 25, 45, and 65-year-old, they're all going to be based on the same health ratings. However, if we adjusted the health ratings, you would see a slight adjustment as well. It's typically not drastic when all things are equal, but that will have an impact on the cash value performance. So the examples we're going to look at are as follows. We're going to look at funding a policy for 5 years, 10 years, and 20 years. And again, the cash value is the goal here. The reason why people are interested in this is because the cash value is a safe place they can put their money, which is extremely appealing right now with what's going on in the stock market. It's liquid, they can access it anytime, and they have that unique loan feature where the money keeps on compounding when they access it, and it's tax-free if we follow IRS rules and we don't mess it up. So what we're going to look at is a 25-year-old, 45-year-old, and 65-year-old. These will all be males in this example. What you'll notice is the design of each policy will be identical. I'll walk through that with you. However, the death benefits will be different, but at the same time, the death benefits will be the same with the goal of maximizing the cash value. So with a life insurance policy, every policy has what is called an MEC limit, MEC, which stands for Modified Endowment Contract. Remember that tax-free benefit with the cash value of a life insurance policy? You can mess that up if your policy becomes classified as a modified endowment contract. If it does, the tax treatment works very similar to that of a 401k. People don't want that to occur. So every policy has a limit. The fun part is we can set that limit wherever we want. What you will find is that with a life insurance policy, the MEC limit has a direct relationship to an individual's age and total death benefit. So when someone says, I want a whole life insurance policy for cash value, and here's how much we're looking to fund a policy with, what we're looking to do is set that death benefit at the absolute minimum based on the dollar amount they want to pay in order to prevent a MEC. This way they can continue to access it tax-free. And reducing the death benefit reduces the cost. Make sense? Hopefully. Let's get into the numbers. All right. So first, we'll look at the actual illustrations, and then we'll look at a comparison on Excel. So what we have first is an example for a 25-year-old. Here we go, 25-year-old. And we see $100,000 per year going in for 5 years. Now we can make this 10K, we can make it $1 million per year. As long as the ratios are the same, you'll see very similar results. So at $100,000 per year, here's all I want to look at. Up here is our base premium. So we've got that less than 10%. It's at $9,091. What's your death benefit at? $3 million. Why? The reason why is because that gives you a MEC limit of $100,000 for a 25-year-old individual, 25-year-old male, with this specific product, which has a guaranteed rate of 3%. The guaranteed rates have an impact on the MEC limit. I need $3 million in order to have the ability to put in up to $100,000 per year. What he's committed to is this base premium plus the cost of the term insurance rider. Let's continue on and look at the 45-year-old individual. So we're going to look at the exact same product here. What do you notice though? So going back to the 25-year-old, now forward to the 45-year-old. Age 45, is the premium different? No, it's not. It's exactly the same. Is the funding different? No, it's not. It's exactly the same. Is the death benefit different? Yes, it is. It's $1.785 million. The reason why is because the older we are, the less life insurance we need in order to get the same MEC limit. So for a 25-year-old, we needed $3 million of death benefit to get a $100,000 MEC limit. For a 45-year-old, we need just under $1.8 million in death benefit to get that same $100,000 MEC limit. Interesting, isn't it? Let's take a look at the 65-year-old. What happens? Age 65. Product is the same. Base premium's the same. Funding's the same. If you've been looking at the cash value, you've probably noticed that's been about the same. We're going to look at a side-by-side comparison. But what about the death benefit? There's the difference right there. Now that's $1,060,000 because that gives us a MEC limit of, guess what, $100,000. So all of these policies are designed equally in terms of minimizing the premium and maximizing the PUA rider in order to get the most cash value. They're all designed equally in the sense of reducing the insurance as low as we can reduce it to prevent a taxable event from occurring. Let's look at a side-by-side comparison. And this again is the example of funding it with $100K per year for 5 years. And then we'll progress on to 10 years with a different company and product. So here we go. What's the minimum death benefit? Age 25, 100K MEC limit, break-even point between years 3 and 4. Our 45-year-old individual, break-even point between years 3 and 4. What's interesting about this, because we need less term initially, it's a little bit stronger up front. This is not uncommon to see when we see individuals in their 30s and 40s compared to their early to mid-20s. But what you'll notice here, same out-of-pocket for 5 years. There's the first year cash value, $88,182. Over here, $88,289. By the 4th year, when we're cash positive, 25-year-old has $407, 45-year-old has $408. As time passes, though, we're going to see more with the 25-year-old. So if we look at year 10, they're getting close, 647 to 651, still in favor of our 48-year-old, or 45-year-old, I'm sorry. And then if we go down to year 20, you'll start to see things follow the normal pattern where the 25-year-old has more. Again, that is normal. And it's especially true if we look at policies on minors, meaning under the age of 18, just with how the health ratings work. But with that said, is there much difference? 20 years down the road, there's not much difference. And we can scroll down further. But first, let's look at our 65-year-old individual. Here we go. So the MEC limit is $100,000 on each of these. The break-even point is the 4th year on all of these. You can tell because your total outlay shows 400K by year 4, and your cash value is more than $400,000. If we look by the 10th year, they're very similar. You will see a little bit less with the 65-year-old. It is true as you get older, there is a slight difference there. The health rating could make that a little bit more slight, and over time it does amplify. But It's often not as drastic as people think. I don't think it's that drastic, but again, it's always up to the individual. We always like to look at the numbers with them and see what they're most comfortable with. But when we look at these comparisons with the same company and same product, they're quite comparable via the cash value. The death benefits, you will see a difference just with how the pricing works and the MEC rules work. Let's take a look at the next example, shall we? So we looked at the 5-year case study. Here we go. Let's take a look at our 10-year case study. We'll look at a Mass Mutual 10-pay, and here we go. So we've got our 25-year-old individual. Chose 26 here because that's his age at the end of the first year. 100K per year for 10 years. There's his base premium at 10% of the total payment. A 10-pay product has a guaranteed rate of 2%. The last one we looked at had a guaranteed rate of 3%. Why that's important is because the lower the guaranteed rate is with a whole life insurance policy, the less life insurance I need for the same MEC limit. So with a guaranteed rate of 3%, to put in 100K per year, I needed a death benefit of about $3 million, whereas with 2%, my death benefit is about $2 million upfront. See how where when the guaranteed rate goes down, I need less life insurance to get the same MEC limit? It's interesting stuff, and we can actually see that if we just go up a touch. There's the MEC limit at $100,000, ran by our chief of case design, Commander Joy Red. She's fantastic. Her and I have worked together for a very long time now. All right, so that's our 25-year-old. Here's our 45-year-old. Look at this. Same minimum premium, same 100 for 10 years. There's your first year cash value at about 90%. Death benefit is lower than a 25-year-old individual. And the reason why is because I need less life insurance for the same MEC limit. A few $100s higher, that doesn't make much of a difference in case you're new to this, which is okay. This stuff definitely takes some time to learn. Okay, and then we've got our 65-year-old individual. Same minimum premium, death benefit is minimized to prevent a MEC. You've got the same 100K per year for 10 years. There you go. Nothing after the 10th year in terms of the annual net outlay. Pretty cool. Let's take a look at our side-by-side comparison. So here we go. Mass Mutual 10-pay, first year cash value, $90,000. Break-even point between years 3 and 4. Next, our 45-year-old individual. Notice the MEC limits are the same on both of them. Break-even point is the same. By the 10th year, is there a difference? A little bit. The 10-pay product, we see the 25-year-old have more from start to finish. Follows more of a normal pattern. Different companies and products, you are going to see that. So if you're working with one agent or multiple agents, don't worry if you're thinking one is trying to pull something over you. If you see, why would a 45-year-old with some companies and products have more than a 25-year-old? Depends on the design. And this is especially true, again, if you're looking at policies on people in their early 20s or teenagers, minors that is. Let's look at a 65-year-old, shall we? Now, the difference here, because we need to use term riders and they get expensive as we get older, instead of having 90% in the first year, we're at 87%. Now, in many cases, when we show folks this, the response is, hey, that's okay, I don't really care about that, but that is more of a material difference there when we look at it, especially when we look at the break-even point. It's really at year 5 compared to the other two at year 4. And this is because of the term insurance costing more as we get older. But it still does work. Where a lot of times when I speak with individuals in their 60s, they feel they can't get life insurance at all, even if they're healthy. And the phrase I always hear is, it's too expensive because of my age, which is not the case at all, actually, which is interesting. If it's designed equally, you can have very similar results to someone in their 40s or 20s. Again, if cash value is your goal, that's the case. But that's your comparison of 100K per year for 10 years And now let's look at 100K per year for 20 years. For this one, we're only going to look at the 25-year-old and 45-year-old, because for the 65-year-old, he'd be 85 by then, and it's rare that I talk to people in their 60s that say, I want to fund this thing until I'm in my 80s. Usually they're funding it with a lump sum of cash for a short period of time. They want to use that money for opportunities and then also supplement income or just leave a legacy. So let's take a look here. Here's our 25-year-old individual. Up top, base premium. Death benefit, just over $3 million. That gives us a MEC limit of just about 100K. With this product, it does have a guaranteed rate of 3%, which is similar to the first one we looked at. There's the funding for 20 years. And then if we look at the same thing here for our 45-year-old individual, there's your 10K minimum premium. Death benefit, about 1.8 million, which gives us a 100K MEC limit. And there's your funding for 20 years. All right, cool. Let's take a look at the numbers. So what do we have first? Is our 25-year-old individual, 100K per year. If you say, how on earth is a 25-year-old going to fund 100K per year? Well, a couple have the ability to do that over the years, which is always cool to see. But remember, it's all relative. So if we look at 10K per year, you'll see the exact same thing or very, very similar results. It's all ratios at the end of the day. So you've got the 100K per year for 20 years, first year cash value, 92.5. Let's compare that with the 45-year-old individual. Here we go, same MEC limit at 100K. First year cash value, almost identical when you look at that. 92,558 compared to 92,565. See what happens when all things are designed equally? You can have very, very similar results, which is just always fascinating to me. What we do a lot of times is look at someone that might be in their mid-40s and they'll want to see a policy on their child who might be 10 or 12 years old and compare both. And it's very similar to what you're seeing here. Or a lot of times they look at it and say, I'll just put it on me. One, because that's easier from an underwriting perspective with how the insurance company approaches everything. But two, I also have the life insurance, which is nice, because now if anything happens to me, even though I'm doing this for cash value, the death benefit is paid to my beneficiaries, income tax free, which is always nice. If we look at the year 20 mark, 3125 compared to over here, 3193, which when you look at that, what do you have there? $60,000 or $70,000 difference. Keep in mind, it's over 20 years. So what you could do here actually, if you like to compare and contrast, we'll call this CV difference equals this minus this, $7. That's not that much. All right, let's make sure we make that red because it's going to be negative all the way down. Come on. There we go. So the difference by year 20, $68,000. Okay. Now, that is over 20 years. So what's that come out to per year? $3,400. That's the actual difference in cash value performance per year. And I've got the life insurance benefit, which is nice. But that's the overview of age. I hope you enjoyed this. This, with a lot more detail, will be coming out shortly in a book that I've been working on forever and is finally finished. I can't wait to put it out there. But if you like this kind of stuff, you get to learn a lot more about different ages, different products, different guarantees. We really dive into the detail and show people exactly what they need to know in order to get a whole life insurance policy to have as much cash value as possible, and then also how they can use that cash value for opportunities through policy loans and such. But anyway, back to the question, does age matter? My conclusion is not really. Technically, it has a slight impact on cash value performance, but if all things are equal, it is very, very similar as long as we keep the same company, same product, and our health ratings are the same. Let us know if you have any questions at all. Please feel free to leave them in the comments below. You can also DM me if you'd like. And as always, I hope this helps. Thanks so much.